So in this video, we'll be like discussing about the financial decision making. So in this video, we'll be like covering these topics: the relationship between an organization's financial objectives and its business strategy, evaluate alternative structures for the finance function using business partnering, outsourcing, and shared global services, marginal and relevant costing techniques, risk and uncertainty, evaluate methods of forecasting, budgeting, channel costing, variance analysis in support of strategic planning and decision making. So we'll start from the financial management and objectives. So the objective of any company is to make profits. Financial management can be defined as the management of finances of an organization in order to achieve the financial objectives of the organization. So what are the financial objectives of an organization? So a company predominantly stands for profit maximization, wealth maximization, gearing ratio, profit retention, and operating profitability. So it is the responsibility of the CFO to ensure that the strategy of the company works in achieving these targets also. So every company has its own unique financial objectives. So some companies give preference for profit, gearing, and profit retention. Some companies give wealth maximization, gearing, and operating profitability. So each and every company has its own financial objectives, but any financial objective it has to match with the strategy of the company here. When compared to the profit maximization and wealth maximization, most companies have chosen the wealth maximization as their predominantly financial objective. So the objective of a private sector organization is to maximize shareholders' wealth. So these are the interrelated aspects of financial management decisions. So as a CFO, he has to think in terms of how to play with the concept of money within the company. So he can get financing from outside of the company. He can get it through retained earnings. He can borrow. He can issue equity shares. Through this manner, he could get the financing for the company. That financing can be invested within the company in terms of buying a machinery, buying a factory, going for an acquisition. So those things are called as the investment part of the company. And as and when you keep on investing in a business, the business at one point of time starts to yield return. So that profit can be either given out as dividend or it can again be reinvested. So this becomes a circle. So either you can use the dividend or you can reinvest it. So if you give out it as a dividend, the money is like permanently moves out to the equity shareholders. So the CFO's main job is to somewhere juggle these three options. So whichever is optimal option, he has to go for that. In some years, he might cut out the dividend and go for reinvesting. In some years, he might stop the investing and go for dividend. Or even in some years, he might stop investing and repay the finance. So something where he would have borrowed, they would have paid back, or the equity shares would have been bought back. So it is a concept where the CFO keeps juggling all these activities. So investment can be in terms of purchase of a new machine, construction of a factory, working capital needs, merger or acquisition. Finance can be in terms of long-term capital like debt or equity or retained earnings. So the company can either go for issuing dividends or not. So you can pause this video and read this area by yourself. So we will see how this actually works in reality. The concept of financing, investing, and dividend decisions. We'll see how it works. This company, as you can see, we have the chart from 2006 all the way to the year 2000, I think it's 17. So you have a lengthy chart of 10 years. This company's share price in around 2008 was something like maximum 100 rupees, and now the company's share price is around 1250. So in a period of 10 years, it has raised around 13 times. So 13 times this, if you have invested 100 rupees in this company, it would have become 1300 rupees today. So this is the wealth creation of the company. It's a very good company, and let's see how it has worked out the financial management aspect. So if you could see here, the company's sales have been like 1465 in March 2002. It's steadily increasing year on year. And in March 2007, it has been 10 times what the sales was. We will see what happens to the profit. So sales has increased by 10 times. Let's see what happens to profit. Profit is at 105. It keeps on increasing and it has gone to 1900. So profit has increased by 20 times. So that is a huge thing. When sales is increasing by 10 times and profit increases by 20 times, it is something like astonishing. So the company is not only increased its profit by way of higher sales, it is also selling higher value products or higher margined products. And look at the dividend. The dividend payout seems to be always at 50% of whatever profit they make. Somewhere it was like 38. So averagely it's around some 45-40%. But either way, we can assume that half the money that they have earned is given as dividend. So they are a good dividend paying company. And let's see the reserves. The share capital is 63 and today it is at 95. It's not a huge increase. Sales increased 10 times, profit increased 20 times, but share capital has not increased a lot. Reserves were 342. Let's see what happens to the reserves. It's increasing. It's increased to a huge amount. Look at the number. It's increased 20 times. So it is like corresponding with the profit number. Let's look at the borrowing. It was 142. Has borrowing increased? Yes, borrowings increased maximum by 3 times. Okay. We'll discuss why borrowings increased by 3 times. Even though this company seems to be having a huge amount of money, why this company is still borrowing, we'll discuss later. But you get a fair idea. This company had 500 of total worth of funds, but now it has 8,500 worth of funds, and predominantly they are a cash generating company. So where they have put this money, let's see. The assets were 400. Now the assets are at 3,300. So of the 7,500, they've also put in assets, and they've also invested in other assets. Other assets can be investments or buying or acquisition of merger. It could have been that. So predominantly you can find out, you can see how the financing, the investing, the dividend are like working in this example. So this is about the company Asian Paints. So you can type it on the internet and find for yourself. So this is about the stakeholders and their financial objectives. There are like many stakeholders with the company, and each stakeholder wants some kind of a financial objective. For example, employees need salary, managers need salary and bonus, directors need salary, bonus and employee stock option plan. Shareholders want higher share price, profit growth, they want dividends. Debt holders want interest and also the safe return of their capital. Suppliers want prompt payment of bills. Government wants prompt payment of taxes and also following their any other penalties or fines that they levy. So these are what the stakeholders want in terms of financial aspects from a company. So we'll now look at the sources of finance. So for a company, they have multiple avenues from which they can raise money. So they can raise it through equity, debt, convertible bond, or also venture capital. So we'll start from the equity issue. Equity is trading up of you sell your ownership in your company and get money for it. So there is a limit to how much you can raise money through this. If you sell 100% of all your equity, then you are not the owner. So we will say that even if you sell 51% of your company, still you are not the owner, because you have sold 51% of your right. If you sell 49% of your stakes to someone else, you are technically owner, but still you have to consider or take the view of the other 49% shareholder, and then only you have to take a view. If you're going to sell 20% of your equity to another person and raise money, you are the majority shareholder. So at any point of time, only when you are a majority shareholder in your own company, you can run your business easily. Or else, to put it in another way, the company CEO has to listen to what the majority shareholders are saying. So the majority shareholders can be single person. Okay, some single person has bought 80% of the shares in your company. It can be another company which has bought 80% of shares in your company, or it can be a group of people. It can even be a group of companies which have bought. For example, if 8 companies have bought 10% of shares, okay, in your company, together they become an 80% shareholder. So they have a high power to influence you. So equity is a very tricky concept. If you want to know about what would happen if you issue too much of equity shares, I suggest you go to Google and type Steve Jobs and equity problem, or Steve Jobs and issue of equities and kicked out of the company problem. So type like that and search for it. You will find a really good videos. So what are the features of equity? If you have bought equity shares, these are the things that you will get. Residual claim to the income. So you will be the last person, if you have, as you are the owner, you will be the last person to whom the income will be shared. Okay. As you also, even at the time of winding up, if the company is going to get closed, you will be the last person to receive the any asset sold, any amount that is still left, you will get it. So who's the first person to get the claim on the income and the assets? It's the debt holders. So as they are only debt holders, they will get the first preference to the income and the first preference to the assets. As you are an equity shareholder, you will get the residual claim or the last claim on the income and assets because you are the owner. But as you are an owner, you have the right to vote and control. And also its limited liability. Assume the company is closed, whatever you invested, that money comes to zero. You are not required to pay anything out of your pocket thereafter. So if you have invested 1 lakh in a company and the company is closed, your only 1 lakh is now gone out. No one will come and claim another even single 1 rupee from your personal assets. So whatever you invested can become zero, not more than that. So we'll move on to the debt financing. So debt financing is issual of debentures, issual of bonds. So these are long-term instruments. So these are your predominantly debt financing. And debt financing depends upon a number of factors based upon which a company goes for debt or equity. One is availability. Debt is not easily available for very small companies. It's only for large companies that can go for debenture issues. Credit rating, only if your company has a good name, good reserves and standing in the market, then only it will get a good credit rating. The higher the credit rating, lower will be your interest rate. The poorer the credit rating, the higher will be the interest rate. Debenture issues are usually done for a large amount. The duration is usually for a period of more than 3 years to 10 years. And fixed or floating. So fixed rate is, the rate is always fixed. The floating rate is, it keeps on fluctuating for every 3 months. So security and covenants, the higher the security, the higher the assets that you have given as pledge, the lower will be the interest rate. If the security and the assets are pledged less, then the interest rate will be higher. And you can't issue a debenture in all the markets, because if the economy is doing well, you can quickly get the debenture issued. If the economy is like doing very poorly, it will become much hard to issue a debenture. So here we look at the difference between debt and equity. If you issue debt, ownership is not affected. In equity, there is a trade-off of equity and money. So you lose your ownership, you get the money. In debt, you have to make the cash payment in the form of interest, but dividend is optional. You can pay this year or you don't need to pay this year. There's no compulsion. Legally guaranteed return of amount borrowed. The company has to return the principal amount, but in equity, there's no necessity like that. Even if you don't give even if the company doesn't return any amount, still you can't do anything. Higher priority in liquidation, in case the company is like wind up or it is closed, whatever assets that has been sold first, it will be like given to the debt holders. If there's anything left, it will be given to the equity holders. There's a stated maturity date. Debentures usually mature, so the company has to buy back the debenture in a particular year, for example, after 3 years or 5 years, 7 years or 10 years. So there's always a maturity on which the debt instrument has to be bought back by the company. There's no such date in equity. For debt, there's no voting rights, they can't vote, but equity shareholders, they can vote. Debt usually has some conditions like the company should not issue dividend, the company should not, the company's interest coverage ratio should not fall below a percentage, the company should not go for additional debt. So there can be like conditions like that. But in equity, there's usually no conditions like that. And the cost of debt is usually low, and the cost of finance of equity is much more higher. So this is against the short-term debt and the long-term debt. Short-term debts are needed to cover to day-to-day running of business. It's usually pay back in a short period of time. So it is usually less risky for lenders. Loans are even within a period of 1 year is a short-term debt. Interest will be lower. Okay, interest will be lower as loan period is usually shorter, but interest rate will keep on fluctuating and it will also be volatile. So even though it is a low cost, it is always volatile. So we can never predict when it will go high or when it will be low. So that is the problem with the short-term financing. Long-term financing is usually for a more than a 1 year period. Okay, it tends to be spent on large projects. So for a construction of a factory or purchase of a machinery, usually these are large ticket items which will pay back over a long period of time. More risky, so lenders tend to ask some form of insurance or security if company is unable to pay loan. So that is what we tell in the names of security or pledge. So companies have to pledge their asset to get this loan. Loan period is more than 1 year. Typically it is in the range of 5 years. Interest rates are usually higher for this because the lenders are not that sure what would happen in the 5 years. So they have an uncertainty element here. So they want a higher interest rate. But interest rates are stable in nature here. A mortgage is an example of a secured long-term finance. So we'll move on to the convertible bond versus a bank loan. Convertible bond has two elements within it. Okay, it has a normal loan, but it also has an equity option. So what are the features of a convertible bond? Convertible bond are debt instruments that can be converted into equity shares of the company at a future date. So if you are going to buy 1,000 rupees convertible bond over a period of the 5 years, okay, at the end of the 5 years, you have the option either to continue it as convertible bond or you can get equity shares of 1,000 each of 1 rupee. So whichever option which is like you feel is good, you can go for it. If the share price is like 2 rupees per share, then if you convert, you'll get 1,000 into 2,000 rupees you will get. If the share prices are somewhere between 50 paise, you will get 1,000 into 50 paise, 500 rupees. So you won't convert. So if it is profitable, you will convert. If it is not profitable, you won't convert. This security has feature of both debt and equity. So this convertible debt usually pays periodic interest just like any other debt instrument. So it is a normal debt instrument. The only thing is it has an option to convert into equity share. But the interest payment is lower when compared to a normal debt. Why? Because there is an option to convert it into equity shares. You can convert it into equity shares if you might get a good higher price when you convert it into equity shares. So this instrument usually pays a lower interest rate. At the time of redemption of bond, the investor can choose to receive share of the company instead of cash. So at the time of redemption, he has a choice of to receive the cash back or the shares. That's about the convertible bond. So now we will move on to the venture capital. So what is venture capital? Assume that you are a startup company. As you are a startup company, you are a very risky kind of a business. You might either become a very good company or you might be flop. So what happens? You can't go for a debt because you might not have such assets to pledge. You don't even have assets, so you can't pledge them. So you can't issue debenture. You can go to a bank, but banks might not be willing to give you a loan because you don't have a proven history of running a business over a period of 3-5 years. Okay, so they won't give you the finance. You can go to the equity market and issue shares, but as you are a company who is not at all have a history of running a business, even you won't be allowed to issue equity shares. So where will you go for funds? The only way to go for is venture capital. So what does a venture capital do? Venture capital is risk capital normally provided by a venture capital firm or individual venture capitalist in return for an equity. These guys give money and they ask for a certain percentage of ownership. So you work and they provide you the money. So together it works something like a small partnership kind of a business, and but at the same time he's a partner for you. So venture capital is capital that is invested in private companies. The venture capital may be provided by a wealthy individual or it may be provided by a venture capital firm that manage a venture capital fund. So what do venture capitalists want? Venture capitalists seek to invest cash in return for shares in private companies with high growth potential. So these venture capitalists are not going to give money to every company. They see whether there's good potential in this business. If they see that potential, they will invest. So they want a high return. And how do they exit out of this business? As this company becomes a bigger company, they then go to the equity market and they list the shares. So once it is listed, the venture capitalist will list first his shares and he will get the money and he will quit out of the company. So venture capitalists usually invest their money in young startup companies and in business which need additional finance to grow. So these are companies which want to borrow money, but they do not, but banks are not prepared to lend, or they might have borrowed from banks too much and still they can't go and ask for money, or it can be that they can't issue equity capital. These are the type of companies whom approach the venture capital. But venture capital is a win-win approach to both the parties here. You can get the capital, the venture capitalist gets a share in a very good fast growing company. So here we will discuss about the ratio analysis. In ratio analysis, there are like many ratios. We will see them in terms of the types of it. So here what I've done is I've given the ratios name, the formula for it. I've expressed it, whether how it is going to be expressed in percentage or in amount or in times or like what. I've also indicated whether the higher is better or the lower is better, and I've also given the meaning of it. So usually in an exam, you will be given an income statement and a statement of financial position. So your job is to find out any ratios that are useful to solve the case. So it's up to you to find out which ratio you have to work out. So we have profitable ratios in terms of ROCE, residual income, operating profit and gross profit. So these are the formulas for it, and all the formulas should be higher, and it also expresses what is better. We'll move on to the liquid ratios. So we have liquid ratios like quick ratio or asset test ratio, inventory turnover days, receivables turnover day ratio, and I've also mentioned the formulas, the ratio type. Okay, what is the ideal ratio also I've tried to give you. Okay, ideal ratios usually I've also given the what it indicates. This is another part of liquidity. So turnover ratios, actually they tell about the efficient usage of the assets. The higher the ratio, the better. It means that we are using the assets to a high degree. So asset turnover ratio tells us how efficiently we are using the assets. Fixed asset turnover ratio tells how well we are using our fixed assets. Our working capital turnover ratio tells how well we are using our working capital. So we also have the capital structure ratio. So whenever the capital structure ratio comes, we have two elements to it: the capital gearing ratio, the debt equity ratio, or we have the interest coverage ratio. So gearing should be as low as possible, or it can be in terms of 1:1 ratio. Interest coverage ratio should be higher the better. So now we'll move on to the capital budgeting part. So these are the types of capital budgeting methods. We have payback, accounting rate of return, discounted payback method, net present value method, internal rate of return method, profitability index method. These are the types of methods. In an exam, you will be like asked which method would be the appropriate in that given case. So I have taken the features. These are the types of methods in capital budgeting, and these are the features of each method. Is it simple to compute? Is it easy to understand? Does it consider the entire life of the cash flows? Okay, so whether assume that the life of the machine is for first 5 years, the machine has 5 years of life. Payback usually considers only the year on which the payback is made, so it might even consider only the first 2 years. So that's a problem with the payback. So whether it considers the entire life of the company, life of the machinery or company, whether it considers the cash flow, because accounting rate of return considers the profit. Does it consider the time value of money? Usually the PB and ARR don't consider the time value of money. Does it maximize wealth? Only one of it maximizes the wealth, that is NPV. Does it focus on risk? All of them does. Can we do any additional calculation? Only with NPV it is possible. What is additional calculation? Something like, can we do a sensitivity analysis? Can we change can we add changes in working capital, or can we like change the income pattern? Can we introduce tax? So several combinations can be made with NPV, but not with other methods. And how they are expressed? Are they expressed in percentage? ARR is a percentage, IRR is a percentage. All the other numbers are whole number. These payback and discounted payback are years. NPV and NPV is a amount. PI is a ratio. So this is how they are. I have given you. So what you do, I think you think over it, you find out how it works, and then you can prepare well for a exam. Usually when they give you several methods, NPV is the most best method, followed by the payback. Payback is a short-term method where it tells you whether you should, which is the very liquid or quickly yielding asset, that it tells you payback. And you can also have PI method. When you have several projects, you can have PI method. The very bad method among these is the ARR, because it uses the profit as a measure. It's the most bad method. So when compared to payback, the discounted payback is much more a better method. And when compared with NPV and IRR, NPV is the far most superior method. So that's how your capital budgeting works. Now we'll move on to standard costing. So what is standard costing? Standard costing is the preparation and use of standard cost, their comparison with actual cost, and the analysis of variance to their causes and points of incidence. So it's a very simple thing. For whatever product that we produce, okay, assume that we produce a eraser, okay, the standard cost of producing an eraser is 10 rupees, okay. Then we find out what is the actual cost. The actual cost is 12 rupees. Then we do one variance, we compare the standard and the actual. So 12 minus 10 is 2. We get a variance. 2 rupees is the difference between the standard and actual. So that 2 rupees is the variance. Okay, it is actually a negative variance, because what we thought was 10 and what we produced it was 12. So why did this 2 rupees occur in the production of the eraser, per eraser? It might be because of the direct material, the rubber, direct labor, the people who are in the production, or it can be of overheads. So overheads can be like anything that is not classified into direct material and direct labor comes under overheads or other costs. Okay, so it's not much about finding the difference of 2 rupees. Okay, it's not about finding the variance. We actually find out variance for finding out from where did this variance occur? Is it from material, direct labor, or overheads? So once we have found out, we have to rectify the problem. For example, we would have used superior quality material, so that might have led to the 2 rupees additional production cost. So somewhere there we have to cut. Or the labor might have been like very lazy, and they have produced very less number of units in a given salary, so that might have led to a higher cost increase. So once we have found out, we have to take a corrective action. So what is the benefit of having standard costing and variance analysis? Number one, it is a very useful tool to control the cost. So at any point of time, we have to produce the eraser at 10 rupees. It is an analysis of variance, so we can find out why the variance has occurred. It helps us even in terms of fixation of selling price. We can know, like, if the cost of producing the rubber is going to be always 12 rupees, then our selling price should be more than 12. It also helps in ascertaining the closing stock valuation, and also about we can also find out idle capacity. So these are the benefits of doing a standard costing. And it also helps to find out which employees or which department employees are working very good, and whom are like not up to their efficient mark. So standard cost tells us where the company is efficient and where the company is inefficient. So standard costing has several benefits here, but they also have several demerits. So one is, establishing the standard is difficult. As it's an eraser example, it was easy. Think in terms of creating a Boeing 747 aircraft. Where would we go for creating a standard costing? It's absolute difficult. Two, even in the eraser case, we can't say that all the factors are constant. For example, the cost of labor, the cost of raw materials are not going to be the same. They keep on fluctuating. So we might think we should produce the eraser at 10 rupees, but there are like many factors which might affect it. The cost of transportation, labor might want a higher increase in salary, or raw material can be not available immediately, so we purchase at a higher price. So there are like several factors which are moving. So standard costing is only an approximate tool. It is not a one single tool which solves all our company's problem. Creating this standard costing requires a specialist. So assume that you are a company which produces shirts. So you need specialist people to find out what is the cost of producing per shirt. So you need experts to do that. And this involves heavy expenditure. To capture the cost, what is the cost, where it is incurred, how it is incurred, who is responsible for that cost, it incurs a lot of expenditure to get all the data. So it becomes a heavy costing. This technique is very impractical for small industries. So these are the broad set of ratios. So we have sales variance, material variance, labor, variable overhead variance, fixed overhead variance. And within each variance, they are usually classified into two. One classification is in terms of the price. Okay, if the variance has occurred because of the change in the amount or price, or the change in the volume. Okay, so usually that's how it works. So we might have got a higher sales than expected, and it can be because of two things. One, it can be because of the volume, the number of units have been sold higher, or it can be because of the price. We have sold it at a higher price than what we thought. So that can be a reason. The same logic applies to all the ratios here, except for the fixed overhead variance. So for fixed overhead variance, you have to be keen with the first two variants alone, the expenditure variance and efficiency variance. The other two variants are not that important. So here I have given you the variance name, the formula for computing it, the person who is responsible for that handling that variance, and what has actually caused the variance to change. Okay, the variance to occur. Okay, what has caused the variance to occur? So you have, in an exam, you might not be required to find out the formula, but you might be required to find out the who is responsible for it and why it has occurred, how you will ensure that the problem is going to be solved. Okay, if assume that the sales that we thought, okay, was 10,000 rupees, but we have only sold for 9,000. Who is the problem? If it's going to be the price variance, then the person who fixed the price is the actual problem. If the number of units sold is a bad thing, then the sales manager has the problem. So it differentiates between the sales manager problem and the higher authority who fixed the sales price. Okay, so it helps to find out who is the root cause of the problem. Okay, so next we move on to the material variance. Again, we have given the name with the formula, who is responsible for it, and when does this variance occur. So if the price is the problem, the material price which is bought is the problem, then the material purchase manager should be penalized. If the material usage, how we use the material, that is the problem, then production manager should be penalized. So it helps us to determine who is responsible for the variance. We can see the labor variance here. We can see the variable overhead variance here. Usually fixed overhead variance will not be asked quite a lot, so we can ignore that. So thank you very much for watching this video. We'll meet in the next video.